The whole world of work, it's just completely shifted, hasn't
Oh,
it?
absolutely. Seismic is the right word.
Millions of us,
Hmm.
no longer tied to a physical office. We've got this new wave of like global citizens, digital nomads, remote workers, freelancers.
It's incredible freedom.
It is.
Yeah.
But, and this is the big but for you listening, this freedom runs smack into this incredibly complex web of international tax laws.
Laws that were, frankly, never designed for someone working from a laptop in, say, Lisbon for a company in London.
Exactly. It can be really bewildering. Overlapping rules, hidden risks, things that can really sneak up on you.
Hmm.
Okay, so let's try and unpack this. Today we're doing a deep dive into the Nomad's Tax Compass using a pretty definitive 2025 guide.
Sounds good.
Our mission here is simple. Demystify this cross-border tax stuff, give you some actionable strategies, and hopefully help you navigate it all with, well, a bit more confidence.
Think of it as getting ahead of the curve.
Right. Your shortcut to being properly informed, especially if you're a U.S. citizen working abroad, that adds another layer, doesn't it?
It certainly does.
So where do we start? I guess the absolute foundation, tax residency.
That's the one. It's pretty much the single most important factor. It decides which country gets the primary right to tax your income.
But it's not just about where you spend the most time, is it? What makes it so tricky? What are the traps people fall into right away?
Well, what's fascinating and where many people get tripped up is looking beyond that simple 183-day rule.
Ah, the magic number everyone quotes.
Right. And while spending over half the year somewhere can make you a resident, it's often not the whole story. The U.S., for instance, uses this complex thing called the substantial presence test.
Okay.
And that doesn't just look at this year. It actually looks back 3 years doing this weighted calculation of your days in the U.S.
3 years. Wow. So even short trips can add up and bite you later.
Potentially, yes. It can unexpectedly trigger U.S. tax residency. And, for U.S. citizens, there's this other critical distinction. Residence versus domicile.
Okay, what's the difference there?
Residence is basically where you live physically. Domicile is more like your permanent legal home, the place you intend to return to. And this is key for those sticky states.
Sticky states. It's like California, New York.
Exactly. They can argue you're still domiciled there, even if you live abroad, and they might try to tax your worldwide income.
Ouch. And federal things like the foreign earned income exclusion?
Yeah.
That doesn't help with state taxes.
Nope. That's purely federal. State taxes are a whole different ballgame.
Right. Okay, so that's complicated enough for one country. But what if two countries think you're their tax resident? That sounds like, well, a nightmare.
It can be, yeah.
This is where it gets really interesting, though. You mentioned tax treaty tiebreaker rules. How do they sort out these clashes? Is it more than just counting days again?
Definitely more than counting days. These tiebreaker rules are built into double taxation agreements, or DTAs, between countries. They set up a kind of hierarchy to decide your single tax home.
A hierarchy. Okay, like what?
Well, first they look at where you have a permanent home available to you. If it's in both or neither, they move to the next test. Your center of vital interests.
Center of vital interest. What does that actually mean?
Think of it as where your life is really centered, where your closest family ties, your main economic interests like business or investments, your social life. It's a holistic view. Where are you most deeply rooted? And, this raises the next big question. Once you do figure out residency, how do you actually avoid paying tax twice on the same income?
Right, the double tax trap.
The main tools are those DTAs we mentioned, which allocate taxing rights, and then foreign tax credits, or FTCs.
Okay.
And for U.S. expats, there's this really critical strategic choice to make. Use the foreign income exclusion, the FEIE, or go with the foreign tax credit.
FEIE.
Yeah.
That's the one where you can exclude income, right? Up to, what is it for 2025?
Around $130,000 of earned income for 2025. And look, it sounds great, and it is great if you're in a place with low or zero income tax, like the UAE maybe.
It's like a no-brainer then.
Well, here's the crucial insight, the thing people often miss. Income, you exclude using the FEIE. You cannot use that money to contribute to U.S. retirement accounts, like a Roth IRA.
Oh, that's huge. That could seriously impact long-term savings, especially if you plan to retire in the U.S.
Exactly. It limits your wealth building options.
Yeah.
Now, the foreign tax credit, the FTC, it's generally better if you're in a high-tax country. Think Portugal, Germany, places like that.
How does that work differently?
It gives you a dollar-for-dollar credit against your U.S. tax bill for the foreign taxes you've already paid. And crucially, it doesn't block you from contributing to those U.S. retirement accounts.
Got it. So you get the credit and keep your retirement options open.
Right. Plus, if you have excess credits, more foreign tax paid than U.S. tax owed on that income, you can often carry those credits forward to use in future years. It's usually the smarter, long-term play in high-tax locations.
Okay, so that covers individuals pretty well. But what about freelancers? Small business owners. I've heard this term. Permanent establishment, or PE. Sounds kind of ominous.
It can be, yeah. It's an often overlooked risk, but a really significant one. Basically, it means your business activities in a foreign country could trigger corporate tax liability there.
Even if you're just a sole freelancer, how does that happen?
A few ways, actually. One common trigger is having a fixed place of business, like if your home office is your regular, dedicated spot for doing your core business work.
So just using your apartment consistently.
If it meets the criteria, potentially yes. Another way is acting as a dependent agent. This means you have the authority to regularly conclude contracts in the name of a foreign client. Your presence essentially becomes their taxable presence.
Wow, okay. So that's subtle but serious. What can you do, practically, to avoid accidentally creating a PE?
Well, mitigation steps. Try to avoid having a single fixed business address if possible. Maybe vary your work locations, use co-working spaces, coffee shops sometimes, hot desking.
We set up a bit.
Exactly. And critically, make sure your client contracts explicitly state that you do not have the authority to bind the client or sign contracts on their behalf. And let me give you just a quick surprising example of these cross-border issues. Think about, say, a Canadian working remotely from Costa Rica.
Okay.
Good news first. Costa Rica has a territorial tax system, so their Canadian salary isn't taxed there. Great, right?
Sounds good so far.
But here's the kicker. Dual Social Security contributions.
Meaning they pay into both systems, Canada and Costa Rica?
Correct. Because there's no totalization agreement between Canada and Costa Rica. These agreements are vital. They prevent exactly this, paying Social Security in two places at once, and make sure your contributions count somewhere.
So without that agreement, you're just paying twice and getting no combined benefit.
Essentially, yes. It's a hidden cost, a kind of double tax you can't offset. Ouch.
Wow, yeah. Okay, so many pitfalls. Which brings us, I guess, to the final piece. Audit-proofing yourself. Documentation.
Absolutely essential. Meticulous records are your best defense.
What does that look like for a nomad? More than just keeping receipts, I assume.
Oh, yeah. It's about proving your movements, your residency arguments, your income sources. Definitely go digital scan everything. Use cloud storage so it's always accessible.
Yeah.
And maybe the most crucial habit, separate your business and personal finances religiously. Separate bank accounts, separate cards. Makes tracking everything so much cleaner.
Good advice for anyone, really.
True. And finally, keep a simple contemporaneous travel log. Just note down every entry and exit date for every country. Seems basic, but it's vital proof.
Okay, so wrapping this up, the key pillars for you to build your global tax plan on seem to be really digging into tax residency beyond just counting days.
Understanding those tests, yeah.
Making that smart, long-term choice between FEIU and FTC based on your goals, not just the immediate tax saving.
Especially considering retirement.
Actively managing that tricky permanent establishment risk if you're freelancing or running a business.
Avoiding those triggers.
And underpinning it all, making absolutely meticulous, organized records.
Documentation is king.
So I guess the final thought for you, the listener, is this. We live in an era where work truly can cross any border. But understanding the rules that govern those borders, that's really the first essential step towards achieving genuine professional and financial freedom out there.
Well said. Knowledge is power in this game.